So our topic today is part two.
Yes, ma'am.
Part two of the first time home buyer roadmap. So
Yeah.
we have given you a quick overview of what it is to be a first time home buyer. There's going to be a link on the bottom for that video so that you can review that as we continue on to part two.
Yes, ma'am. So part two, as we go over that roadmap, was a very short bullet pointed roadmap of what we do to get a buyer from I think I want to buy to here's the keys and 1 year beyond. So the next step in that is your financial foundation, and that is actually the most important part of the roadmap, because without funding, how do you pay for the home? When you're thinking about buying your first home, your financial foundation is literally everything. Think of it like the frame of the house. If it's shaky, it's going to be very stressful. And if it's strong, that process is a lot smoother and you'll have confidence moving forward. So there's four things that you're going to do. You're going to check your credit early. You're going to reduce your debt and boost your savings. You're going to look at pre-qual versus pre-approval, and you're going to think about long-term affordability. So let me break that down. Um, and this is where Cathy comes in, and she's just the integral part, the cog of this wheel in the financial foundation. You need to connect with a lender early in your home buying journey because it's a game changer, especially if you're a first time home buyer. And I'm going to talk to you a little bit about why it matters so much. Cathy, the first thing you do is you collect financial information and you help the client know what they can afford. And you help them set a budget. And there's a big difference between pre-qualifying and pre-approval for the mortgage. But how important is it to give a client a realistic range when they're looking at their home buying power?
So I'll give you an example when I first came to San Diego, right? So I ran my credit. It was in the 500s. And so I had to rent. So as I was renting, I created this budget worksheet for myself to say, hey, I need to do A, B, and C in order to, one, get my credit scores up, and most importantly, feel comfortable about getting the home that I want. So once I started working on my credit and started working on my budget worksheet, then I was able to go from a person who was working on becoming a home buyer to a person who now is, I was pre-qualified because I pre-qualified myself, to pre-approve, which means I had to talk to a lender. They had to officially run my credit. Once they ran their credit and they got all the documents together, they say, hey, Cathy, you qualify for A, B, and C. Let's go. Let's go find your place. So the interesting thing about that is when you're doing your budget worksheet is how much are you paying now for rent and how much are you willing to pay to become a homeowner, right? So I started out with a 2-bedroom, 2-bath apartment rental, ended up with a 2-bedroom, 2-bath condo, right? And at that point, only had to pay maybe $600 more a month to become a homeowner. Okay.
That's awesome.
So in the budget, that's what we did. I said, okay, let me pretend I'm making that extra $600 payment so that I
Yeah.
can get used to it. And then that $600 was what I was able to use for my closing costs when I purchased my home. So that's what's so important about getting things started early, because Collette and I are very patient. We have people who are going to buy in 30, 40 days from today, and we got people who are going to wait 6 months, 9 months, 12 months.
Yeah.
We want you to be comfortable with the payment you're going to be making, but at the same time, Colette's going to let you know, like, this is one of the reasons why she does the high and low, is because of the marketplace. It might be better for you to invest now if you have the ability to make the mortgage payment
Yeah.
than if you did it.
So and there's a big difference, Cathy, when you
Mhm,
talk to people, there's a big difference between what you can afford versus what you want to pay, and that's
mhm.
where that budget worksheet comes into play.
Right.
And you said something that I really love. You said just because you can write a check doesn't mean you have to.
That is it.
There's oftentimes a difference in what a buyer qualifies for and what they actually want to pay, and there
Mhm,
could be a discrepancy. So you really have to think long term
mhm.
about what the quality of life and the type of things that are important to you that you want to spend your money on. So that's those are all. So that's the first step: is what can you afford? The second thing that a lender does is they help boost your credibility with sellers. So I talked about pre-qualification versus pre-approval. And in the pre-qualification process, you look at a rough estimate of what their financial foundation looks like, and you tell them you could qualify. Looks like here's the round figure that you're looking at. It's more a ballpark. Whereas the pre-approval, you've collected their pay stubs, their 1099s, their taxes, and you've taken all of that actual financial data and analyzed it, and then given the real deal amount. Like the lender portion is verifying that credit, income, assets, and it shows exactly how much can be afforded. And have you seen more success for your buyers having that pre-approval in hand versus just the pre-qual?
Absolutely, because I'm sure many of you get a letter in the mail saying you're pre-qualified. You're pre-qualified for this credit card. You're pre-qualified for this. You're pre-qualified for that. You're pre-qualified. What is it? It's just a list of numbers saying, hey, you might be able to get this. The difference between that and being pre-approved, as Collette has already listed what has happened, is that because we verify your information, we say we have the opportunity to help you become a homeowner based on the information you gave us. We do your income, your credit, and then, of course, there's different loan programs that go with it to make sure that you have the option to choose what's going to be best for you and your family.
And as the realtor, I will tell you that there's a lot of home sellers that won't even offer or entertain looking at your offer if you've shown the home, if you've seen the home, and you want to offer for it. They actually won't even entertain your offer if you do not have that pre-approval in hand. So it's a
Along
vital
with proof of funds.
along with proof of funds. So it's vital that you put that step prior to actually pulling the trigger on looking at homes. And so the tip for this section is get your pre-approval prior to shopping. It gives you the confidence, and it shows sellers that you're really serious and you're not just dabbling and being a looky-loo in the homes. And so in a competitive market, it helps you have an edge over other buyers, and that's really important.
And in that, we also, I also provide a little video to let you know, here go the different loan programs that you may qualify and get pre-approved for, and then show you what the PITI, which is principal, interest, taxes, and insurance, mortgage insurance if you don't put down less than 20% down, depending on what kind of loan types you get, so that before I send you over to Collette, you have a very good idea, because interest rates change daily. You're going to have a great idea, a better idea, feel more comfortable that before you walk into that door, you know the rough estimate of what that mortgage payment could be, along with the loan type that goes with it.
And so you segued for me right into the next section, which is getting guidance on the loan option. So what your lender will do for you, Miss Cat here, she's helping first-time home buyers qualify for special programs. There's often low down payment assistance programs, reduced rate options, buy downs, and then the lender is going to walk you through the different products if you're a military spouse, or excuse me, if you are a military family, active duty or veteran, you have a VA package. If you're a first-time home buyer, which could be every 3 years, FHA, USDA, and conventional. And there's a variety of assortments of programs underneath each one of those. So that's what Cathy does, is she looks at that financial information, and then she helps you ascertain what's the best option for you. And I love the video that you put out, because it shows conventional 5% down versus a FHA 5% and a VA 5% or a VA 0%. So it helps you kind of navigate what you have in the way of assets to what product is the best fit for you financially. And that could really depend on your credit score and your down payment. So all of those things vary person to person and financial situation to situation. So the next thing that your lender is going to help you do is understand your credit and help you improve it. So when you sit down and talk to a lender, they advise you on your credit score and help you understand bettering your score and what steps you need to do to do that. The higher your credit score, the better your interest rate. And because it makes you a less risky lending opportunity. So, and the better your interest rates are, the lower your monthly payment is. And so, when you're looking in terms of getting that score up, how oftentimes, Kat, people think that they just have to pay everything off to get a better credit score. And as a lender, you kind of help walk them through that because that's not always the case.
That's correct. And that's part of the budget worksheet process, in which you all have a section to put in how much credit card debt you have, student loan debt you have. As a lender, we only go by the minimum payment you have to make, not the bulk of what you owe, but the minimum payment. So let's say you have it and you have to pay $100 a month, but you put $250 every month because you're trying to pay it off. Once you decide to become a homeowner, we really tell you, do the budget worksheet, just pay the minimum amount. Let me help you with the analysis so that we can determine, why spend money, an extra $150 here, when we can spend $150 here, either saving or utilizing it to maximize the benefit of your credit. Because everything's online and we have all this AI, people can go in and ask all these questions, but it is better for you to actually get the credit pulled by a professional like myself,
Yeah.
because it pulls all 3 credit bureaus. And then I can definitely give you an analysis to say, hey, you got this much debt, but you only need $300 to really qualify for this loan. Woo-hoo!
Yeah.
Versus you stressing yourself out trying to do stuff that that may be hurting yourself, or not really getting the benefit of really increasing your credit scores.
I love that. So we're going to be looking for errors. You need to make sure that all bills are getting paid on time.
Mm-hmm.
They have to have no lates in a 12 month period, correct?
Nope, not necessarily.
Oh, not
So
necessarily. Okay.
depending on what type. So if you have a mortgage late, that's totally different. If you're first time home buyer, you don't have one, right? Just
Right.
like medical bills, there's certain things in the credit, which is going to be another section when we really
Yeah.
deep dive into the credit. There are certain things that could be on your credit. And if you have a late, that's why it's important that we pull it, because we pull all 3 credit bureaus. We pick the middle of the 2. I do an analysis of your credit report to say, hey, this is what's showing. So if you did have a late and it was a credit card late, it affects your credit scores, but does it really affect your ability to pay? So those are the 2 different things in regards to when you're working with, do you have the ability to make this mortgage payment? Yes, you had a late. They may ask for, why was it late? Depending. Now, if you had 12 lates, 12 different lates from 12 different credit lines, obviously that's going to affect your credit score. And then again, like I said, Collette and I are very patient. We're going to just walk you through. So every 30 to 40 days, right, we're going to monitor. You're going to be the one that's going to be proactive and say, hey, Kat, I'm doing good, blah, 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 blah. Great. Because credit, right, is just like losing weight and gaining weight. Boy, to lose weight takes a lot more than to gain it. And the same thing happens with your credit. When you have credit, you screw up once, you could have the best credit in the last 10 years. Screw up once or twice, and boom, your scores go down. So it takes a
Yeah.
little longer for the scores to go back up. But again, Collette is a patient realtor in which we're here to help you, walk you through each step of the way. So if you're ready to buy right now, call Collette.
At 619-838-1696.
Right? Because we're here to educate. Educate.
So I will say that it's rare that buyers are just, hey, Collette, I'm ready to buy, and I refer them to you and they're ready to go. That is not actually the use. Normally, it takes on average about 6 months for a majority of my clients to be, to clear up things off their credit or to have a little bit of extra savings. So it's not unusual to not be able to immediately pull the trigger. I've worked with clients as long as 24 to 36 months prepping and getting ready. Sometimes that was waiting for something to fall off their credit that was due to fall off at a certain point. And so it really does vary. Credit is like anything else, is very individual.
Mhm.
So the next thing that a lender is going to help you do is plan for those upfront costs. Besides your down payment, there's also closing costs, insurance, and taxes, like you mentioned. And so what CAT does is help you prepare for these so that you're not caught off guard during the transaction. Now, during when you do that worksheet, you help look at an reducing debt and boosting their savings to get them to where they want to be, correct?
Correct. There's something as simple as once you get really take a look at this budget worksheet, and that'll be another video that we'll do,
Yeah.
is when you actually see where all your money's going, you get a shift in your mindset. I really want to be a homeowner, so I need to start doing something different. And so that money that was going for ABC can now go to here. And this is where Colette's saying that most buyers, it takes them a couple of months to get things done. On top of the fact, people are like, I'm going to wait for rates to go down. Don't wait for rates to go down, because if the thing with us, right, we want to get you pre-approved. So it's like a checkbook. Get pre-approved. Yeah. Then if you see a house you like, then you can write a check. But if you're going to wait for rates to go down, you're not pre-approved, you find the house you want, you call Collette, it makes it a little more stressful for you versus some of the planning and preparation that you can have to say, hey, I'm pre-approved, I'm patient, I'm going to look for the house that I want. When I get the house, then you can then write that check.
Absolutely. And why don't you explain what their debt to income ratio is?
Well, to get into
And why
that
it's
is,
important.
yeah, there's two parts of it, right? So it's how much money you make, right? And how much credit card or car payments you have. That's the first part of the debt to income ratio. The second part is now we add your mortgage to it, right? So each loan program have different parameters for your debt to income ratio. Well, that'll be another video, right? So
Absolutely.
depending on your credit scores, as Collette has mentioned, I can give you an example. VA is one of the best loans you can have. I've had people with 65%, that's right, debt to income ratio with their
Wow.
mortgage, and VA will, you know why they'll do it? Not necessarily just the credit scores, but because they got reserves, 401k, money somewhere to say, hey, if anything were to happen, I can make that mortgage payment. So that's one of the reasons why your debt to income, that's why we have to pull your credit to have the whole story. And then based on that debt to income, so VA is the highest. You got FHA and conventional, usually it's 49.99%. So
Yeah.
you take your income plus whatever your credit card and car payments are, you add your mortgage, and all together, depending on your credit score, will indicate the max debt to income ratio they will allow you to have.
Which will impact their purchase price, correct?
Absolutely.
Okay.
Along with the interest rates, as we know, which has more than doubled since COVID. So that's the biggest thing I think delay is for most buyers, is that they're waiting for rates to go down. Where we're saying get pre-approved, because even if the rates are higher now, if you want to sit and wait, we got another worksheet on that too, that because of the equity growth versus the interest rate, you could potentially be losing money or paying $20 more instead of waiting for an interest rate to drop and potentially lose out on the home that you want.
Absolutely. Because right now, prices are not trending up. But when they were, people were on the fence waiting for those rates to drop. But in the meantime, the offset was that the prices were rising. And
Mm-hmm.
so by the time that rate dropped to where people wanted to see it, you could be paying, you know, 50, 60, $70,000 more, which doesn't actually save you money. Getting your foot in the door at that price and then refinancing when rates drop to a more palatable place is actually more advantageous. So those things are all really important to think about. So in the realm of reducing debt and boosting savings, you want to save not just for your down payment, but also for closing costs, moving expenses, emergency cushion. Maybe you want to redecorate the home when you get there because the furniture you have now doesn't fit because it was, you know, your college dorm furniture. So those are all really important things. A good rule of thumb is to aim for at least 3 months 3 months reserve of your expenses. So the
And
next thing,
don't get scared about that, because remember, you got your 401k, you got retirement, you got stock,
right?
you have other assets that you could potentially get. But the biggest thing about the budget worksheet is I'm going to help you really structure, because most people have at least 1 month,
Yeah.
at least. If they're considering to purchase a home, most of them have at least 1 month of reserves.
So the
Like I
last
said,
step is looking at locking in the rates and starting the clock. So you've gone through the process, you've pre-qualified, you're ready to buy. We're looking at homes. And so you're looking at locking in the rate and starting the clock. So mortgage rates obviously fluctuate, which is why we talk about it week over week. And connecting early with your lender helps you look at what those favorable rates are and when the right time to lock your loan is. Can you explain what a loan lock is?
uh, a loan lock is, give you an example. As of today, I have a client. They have a they have an offer in, so they're going to have to make a decision. Do I take an interest rate that gives me a credit? And in this particular case, they could potentially get $3,000 as a credit for their closing costs. However, the interest rate's a little higher. If they select to get that one, then they get the $3,000 credit, which reduces their closing costs. However, if they choose to get the interest rate that's a little lower, they save $90 a month, right? So if you do the math, 90 times a month times 12, what's your
Times
return
30.
on investment? But that could be crucial because, as things are expensive, milk, butter, all that other stuff. But then you look at your cash flow. So when you go, okay, so I'm gonna have the conversation, I do the little video, here go the rates. Then I get on the phone with you and say, hey, you can get a credit. You see the payment. What do you want to do? And then it's up to that family to say, yes, I'll take that rate. We then lock that rate. When we lock the rate, when she's saying starts the clock, we did talk about when you make an offer, it gets accepted. You have a 21-day to get everything done. You have 30 days to get everything done. And then depending on how many days we need to get done, will indicate how many days we're going to lock it. So I like to do, if I usually do 21-day closes, I like to do a 15-day lock, because the borrower saves money,
Yeah.
right? Believe it or not. Versus I could do a 30-day lock, but then we're taking a chance, right? But most of the time we're really proficient in what we do. Most of the files go through smoothly. And if then that again saves the borrower, because it's all about you guys. It's all about you saving money. So that is the purpose of locking your rate. And it's just like playing the lottery. Okay. I can tell you, play this number, you might win. It's just like interest rates. I can
Yeah.
say we can lock the rate now or tomorrow. You have to make that decision. But usually after we do lock, the following day or so, I will let them know more than likely you made the right decision. Why? Because we're moving forward with that contract. We're moving forward to get you the keys to your house.
And that's really the important part, right? So the underwriting process starts once you lock that loan. And we just want to close by saying you really need to think long-term affordability. And it's not just about the loan. It's, just because the bank says you can borrow a certain amount of money doesn't mean that you actually should. And so you have to take a look at your lifestyle. Do you travel? Do you like to eat out? Do you invest? What type of things are you interested in starting a family? So all of those things are very individual. And so when Cathy and I meet with you and we discuss what your needs are, we want to make sure that your future mortgage payment leaves room for the life you want to live, not just that roof over your head.
Well, that was great. So, again, if you have any other questions or concerns, please give a call to Collette. What phone number should they reach?
619-838-1696.
Okay. Bye, everyone. See you next
Bye.
week.